Hello everybody and welcome to my channel. In this video, we are continuing our discussion on business valuation, and as I promised in my previous video, we are coming to look at a practical question and we will learn how to um, use this question to actually apply the business valuation methods we learned in our previous video. Now, so if this is your first time watching my video, kindly go back and watch my video on the introduction to business valuation methods so you can follow along in this particular video. All right. Now, in the exams, business valuation methods are actually any business valuation method can be given to you in the exams, and so you would have to enter the exams room with a range of these valuation tools at your disposal. So just so you can have yourself sorted out when you see any of the valuation methods. So in this question, we have a very simple question here that we want to look at. So we have the shareholders of ABC Limited, a successful business, family business, planning to offer 2,000 of their shares for sale to the public. So ABC Limited, a family business, is planning to offer 2,000 shares for sale. So what we are coming to do is we want to know the value of these 2,000 shares. And so we are coming to look at some of the valuation methods that we want to look at. So let's follow along. So the summarized balance sheet of the company as at 31st December 2022 is as follows. So we have the long-term assets, current assets, and then we also have share capital. We have 5,000 ordinary shares of no par value. We have income surplus, and then also we have 18% debenture stock. That is the long-term liability element. And we also have some additional information here. So we have extracts of the retained earnings account from 2018 through 2022 as follows. So we have our net profit after tax. Let me enlarge this. So we have our net profit after tax for the various years. We have the dividend as well as our retained earnings. Then the following information is relevant. So 1, the shares were issued several years ago. So which shares are they talking about? They are talking about the 5,000 ordinary shares of no par value. Included in the long-term assets is a piece of land which cost $9,500. It has recently been valued professionally at $29,500 in its current use and at $37,500 as residential land. So I'm coming to read from the so instead of I want to read from here from the formula bar. Alright, so as residential land, the valuation has not been incorporated in the accounts. And also we have the directors have applied to the regional authorities for a permit for a change of use of the land. In addition, they are arranging alternative premises at a rental of $2,850 per year. And we have the IV $1,000 of trade debtors is considered irrecoverable. And the last information here, we are saying that the directors have decided that XYZ Limited, a quoted company which manufactures similar products as those of ABC, provides a relevant comparison to ABC. Now, so we are using XYZ, which is a listed company, to value ABC, which is unlisted. Alright, so just take note of that. Now, the following information relates to XYZ. So we have dividend per share, price per share, earnings per share, and then also the book value of net assets per share. Now, the requirement, we have to suggest a price range for the sale of 2,000 shares of ABC Limited to the public using each of the following methods. So we are to use the earnings based methods, we have to use the dividend yield, and then we also have the net assets. And then the B part of the question is, in any takeover bid, both buyers and sellers have a price that they realistically hope to achieve. outline any 4 factors that shareholders of ABC Limited may consider in fixing the final price. Alright, so let's see how we can solve this question. Now, I said that the XYZ is the quoted company and the ABC is unquoted. So we are going to use what is available, adjust it as a proxy, and we are going to use it for the unquoted company ABC Limited. Alright, so let's see how we are going to do it. I explained that a whole lot in my previous video, so you can go back, watch it, and then you come back to follow this. Alright, so we are going to look just into that. So the first one here is the earnings methods. So the earnings method, we are going to look at the PE ratio. The PE ratio, and from the previous video we got to know that the PE ratio is actually equal to our market price per share divided by the earnings per share, and we are interested in the MPS, which is the market price per share. So we will calculate our MPS. We'll make the MPS the subject, and that will be equal to our PE ratio. So we are making MPS the subject multiplied by our EPS. Right, so that is the formula for calculating the market price per share using the PE ratio formula. Okay, now we are going to look at each of these and then we will see how we will go about it. Now, the first component we will look at, which is easily found or which is quite easy to find, is the EPS. So what is our EPS? Our EPS, as I said in my previous video, is the earnings, talking about the earnings after tax, and then we'll divide that by, okay, so it's earnings after tax and dividend. That is actually the full thing, and then we'll divide that by our total number of shares. Alright, now what is our earnings per share? Let's go back to the question. Our earnings after tax, so we are considering the year 2022. That is the year we are considering. So the earnings for 2022 is this 42,700. So I'll come here, and what I'll do is I'll have equals 42,750, and in my additional information I've been told that 100,000 of our trade debtors is considered irrecoverable. So let me actually draw something here. Sorry, okay, so that is not possible because I've selected this particular. So the note 4 is saying that $1,000 of our trade debtors is considered irrecoverable, and so this is an expense that we need to take away from our earnings. So we'll take that and we'll subtract our $1,000. So that is giving us 41,750. Now what do? We are coming to divide this by, so divided by our total number of shares to get our earnings per share. So I'll divide that by 5,000. So that is very wrong. So let me actually put this in brackets. Supposed to put this in brackets, and then I'll hit enter. So my brackets here, then I'll hit enter. So let me format my increase there to actually 2 decimal places. So that is our EPS. Let me actually cut it and put it in front of my EPS here. So that is our EPS there, 8.35. Then the other one that we want to, the other component of earnings per share is the PE ratio. So the PE ratio, as we know, is equal to the MPS, or the market price per share, divided by the EPS. So what we are doing is that, so let me just write PE ratio. So I have the PE ratio, and what we mean here is that, look at this, let me put it here. Okay, now what we mean for the PE ratio, we are going to consider the PE ratio for the listed company. And so we are going to use the PE ratio for the listed company and then adjust it for any risk that we are going to assume, and use it as a proxy for the unlisted company. So we know that PE ratio, as you have defined here, is equal to the MPS, market price per share, divided by our earnings per share. So we are going to find our market price per share for the listed company and divide it by its earnings price per share, and then we will use that, adjust it for any risk, and use it for our unquoted company. So this is what we have. We have equals the market price per share, which we have right here, 45,600. We will divide that by our earnings per share, which is 5,700. I will get that, and let me actually increase the, okay, so that is exactly it. And assuming we want to find the market price of our quoted company, this is, we will just find the EPS for our quoted company, and then we multiply it by the PE ratio to get our market price per share. However, we are looking at the EPS for our unquoted company, and so this particular value will have to be adjusted for the risk. So let us assume a risk, of say 20%. So assuming a risk of 20%, what we are trying to do is that this value here is 100%, and because of the risk the unquoted companies face, we are going to scale the PE ratio down. Now, if you want to know more about the PE ratio, what it calculates, refer to my previous video. And please kindly subscribe to the channel if this is your first time watching my video, because I'll be releasing a lot of videos on these things. Financial modeling, I have a financial modeling video on trade statement financial modeling, so you can check that out in my videos. I have videos on ratios, accounting ratios, and other key accounting concepts. So let's continue. So I'll scale this particular value down by 20%. So this is 100%. So I would have 100%. So I'll have my 100%, and I'll subtract 20%, which is my risk assumption, and I'll get 80%. So let me actually put my equal to sign just so Excel can recognize it. So after getting our 80%, what we do is that we will have an adjusted PE ratio for our unquoted company. So we have adjusted PE ratio for the unquoted company, and that will be equal to our 8%. So let me set my equal to sign, and that will be 8% multiplied by the 80%, and that we have 6.4. So let me increase it to at least 2 decimal places. So that is 6.4. So this 6.4 is what we are going to multiply by our EPS to be able to obtain our market price per share. So we write therefore comma, we have MPS. So our MPS will be equal to the 8.35, which is our EPS, multiplied by our PE ratio, and that is 53.4. and this is actually in dollars. Let me format it as a currency instead. Alright, so that is it there. So this is our EPS. So this is the price we are likely to quote for the $2,000. So we can say that the 2000, so we have our 2000 shares will cost, how much will it cost? It's going to be 2000 multiplied by my number of shares here, which is 53.4, and so this is the amount our 2000 shares will cost us. Alright, so that is it for the PE ratio. And the second earning based ratio we want to do is the earnings yield. Is the earnings, sorry, so we have the earnings yield, and as we have seen, the earnings yield is actually the opposite of the PE ratio. So we know that PE ratio is equal to MPS over EPS. For the earnings yield, or EY, it is equal to the EPS divided by the MPS. And so our MPS under the earnings yield will be equal to the EPS divided by our earnings yield. We just did a change of subject. So just as we did for the price or earnings ratio, we are going to calculate our MPS for the quoted company, in this case XYZ. So we'll have the MPS for XYZ, and that will be equal to, and that is going to be equal to as the formula goes, the earnings per share. So we can get the earnings per share here. So we have the earnings per share for our quoted company divided by the MPS. Divided by the MPS. So I'll hit enter, and that is 0.125. Now this is our MPS for the quoted company. So to be able to use it for the unquoted company, because of the risk we are expecting, because of the risk of the unquoted company, we are going to assume a risk. Once again, we'll assume a risk of 20% of this particular market price per share for the quoted company. So that is going to be equal to this multiplied by 0.2. So we have 0.2, sorry, so that is going to be 1.2. So we are increasing it by 2%, because as I said in my previous video, because we are assuming a risk, or because the business faces a higher risk compared to the listed company, because they are generally unregulated and their shares are unmarketable, we usually increase their returns, because in finance there is a positive relationship between risk and return. So the higher the risk, the higher the return. That is why we are increasing the risk or the return on this particular investment. Okay. So we hit enter, and then we have 0.15. So that is our 0.15. So this represents the yield for our unquoted company. So this is the earnings yield for our unquoted company. Alright, so with this earnings yield, we can calculate the market value of the ABC company. So we have the market value being equal to this amount So we know our market value is going to be the earnings of EPS for 2022, and that we have calculated it to be 41,750, and we got that by taking the earnings, which is 42,750 for 2022, and subtracting the value of trade debtors. So that is 41,750. So I'll come here and type 41,750 and divide it by my adjusted earnings yield. So I have that, and that is the market value for ABC Limited. So that is our market value for ABC Limited. So but we want to find the market price per share. So this is the entire market value. Let me actually edit that. So it's actually a currency. Very good. So we have that, and then we are actually looking at the price per share, and this is our market value. So MPS for ABC will be equal to this value. So we have to be equal to this value divided by our number of shares, which is 5,000 shares. So that is $55.68, and we are looking at the valuation of 2,000 shares. Therefore, we have the value of 2,000. So the value of 2,000. So the value of 2,000 shares will be 2,000. So let me put my equal to sign. So it's going to be equal to 2,000 multiplied by our MPS. So that is $111,357.33. So that is it for the earnings yield. So these are our earnings method. Now the dividend has been separated from our earnings method. Had it not been separated, we would have added it as a earning based method. Alright, now the second one we are to look at is the dividend yield. That's the dividend yield, and the dividend yield follows the same logic as our earnings yield. So we have dividend yield dy equals our dividend so we have dividend per share divided by our earnings or market price per share. So whenever you see yield, we are talking about the market price. So that is it. And as we did for our earnings yield, the same logic applies here. So what is our MPS? Our MPS will be equal to the DPS, or the dividend per share, divided by our dividend yield. Now what is our DPS? What is our dividend yield for 2022? That is going to be equal to the dividend for 2019, which is 19,000, divided by our total number of shares, which is 5,000. So I'll type my 5,000, as you can see from the formula bar here, 5,000. So I'll type that and then I'll hit enter. So that is our dividend per share. That's our dividend per share. And for the dividend yield, we are going to use that of the quoted company. So our dy is going to be equal to, so let me just cut this. Okay, I think it's fine. Enter that. So our dividend yield is going to be equal to the, as we can see, is the DPS divided by the dividend yield, and that information can be gotten from our question. So I'll go type equals. I'm not actually done. Okay, so I'll type equals and go to, it is dividend per share over the market price per share. So I'll come here, my dividend per share, divide it by the market price per share, and we have this. But since this is for the quoted company, for us to use it for the unquoted company, we will assume the risk of 20%. So dy, we'll say dy for ABC. So this is dy, let's correct that. This is dy for dy for XYZ, which is the quoted company. So the dy for ABC is going to be adjusted for the risk. So we're going to pick this and multiply it by 1.2, or which is 120%. So I have that. So that is it for the unquoted company, and therefore our MPS, which we have quoted as the DPS over dy, for the MPS for ABC, this is actually DPS. So this is actually our DPS for ABC. So our DPS for ABC, and that is equal to this. So I'm going to cut it and paste it here. So our MPS for ABC is going to be equal to the DPS, as you can see in the formula, divided by the dy, or the dividend yield. So I'll hit enter, and that is 50.7. Hence the value of 2000 shares will be is going to be equal to this multiplied by our 2000 shares. I'll hit enter. So that is the value for the 2000 shares that we will have. Alright, so it means that we are going to quote a price that is around, or a value for the 2000 shares that is around this figure when we are using the dividend yield method. Now the last one per the question is the net assets. Now the net asset is the simplest you can ever do, because as I said in my previous video, it is formulated as a result of the basic accounting equation: assets equals capital plus liabilities. So let's go. The third one is the assets. So we have assets based method. Now in this question, we are not given the replacement cost. We are not given the break or the net realizable value of our assets. All we are having is the book value, and so we are going to use the book value to value the business. So this is going to be the book value method. This is the book value method. Alright, so in the book value method, as we saw, is going to be equity, which is our market price of the equity, will be equal to our assets, and then we'll take away the liabilities. So basically what we've done is we've taken the accounting equation and made equity the subject. So this is the principle you are going to use for the asset-based method. So I'll come here and then I'll write assets, and our assets, I'm going to link them here. So I'll go back to my question, and our assets are 2. So I'll come here and link them, and then I can copy them. Okay, so I'll come here, copy, come here, copy to the right, so that my values will come. However, I want them to be here, so I'll paste, cut this, and paste. Okay, great. So we have that, and in our question, we are told something about the land. So let's go back to the question and see the additional information. It says included in long-term assets is a piece of land which costs 9,500. So the land costs 9,500. So what that means is that included in this 190,000 long-term asset value is a $9,500 relating to land. However, we have been told that it has been recently revalued by professionals at $29,500 in its current use and at $37,500 as residential use. So this is the higher of the amount, and so we are going to use this as the value of our assets of the land. So the land is no longer 9,500, neither is it 29,500 in its current use, but this is the actually the revalued amount of the land. So I'll come here, and what I'll do is, okay, so I'll have here land. What is our land value? It is 9,500. I'm going to take it off from the books, so that will be equal to 9,500. Let me make it negative, because I'm going to take it out from the books, and we will have revalued land amount, and that is 37,000. Let's look at it. So that is 37,500. So I have my 37,500 there. So we have taken away the old amount, which is now irrelevant, and then we are adding back the revalued amount. Alright, and then the next thing we want to do is we have a current asset element here, and we know that included in current assets is receivables. Now the question or the additional information tells us that 1,000 of our receivables are considered irrecoverable, and so that means that our receivables amount has reduced by 1,000, and so we'll have here and write bad debt, and the amount is 1,000, and that is going to be subtracted. So 1,000, this should be negative, so I have that 1,000. Alright, now I can add everything together. So that is it for our assets. So that is it for our assets value. Alright, so that is it for our assets value. So I'll add everything together. So we have alt equals, that's a shortcut form. Sorry, adding the wrong thing. So I'll come here and add my assets together, and I'll have alt equals to add everything together, and that is 312,000. And as the formula goes, less liabilities, and so I'll come here, liabilities, and the liabilities, we are talking about the 18% debenture stock. That's the only liability item we have. The other two, this is our retained earnings, and this is our stated our share capital. So this is the only liability item we have, so we take it away. Let me copy the formula so I can get my figure. So that is 80,000. I'll come here, Now let me actually cut it from here and paste here. And what I will do is I'll make it minus because we are subtracting. And so our value, so the market value of the business, so we have our market value of the business will be equal to this minus okay, so it's already minus, so I'll add plus this, and that is 302,000. So our market price per share is going to be equal to this amount divided by our total number of shares, which is 5,000. So that is 46.6, and this follows that so we have therefore this follows that our 2,000 shares, 2,000 shares, which is very shares, will be equal to this value, the market price per share, multiplied by the 2,000 shares. So that is 92,800. Alright, so this is how we calculate for the our various valuation methods. Okay, so that is it. Now the question says that we are to suggest a price range. So a possible way of doing that is after using these values to calculate the PE ratio for the quoted and then adjusting it for the risk. After using these two values, you can use the average as well. So as you use this one for the EPS, you use this as average, and then you can say that the price is going to range between this for 2022 and then the average. So let me see how I can demonstrate that. So you come here, we know that our the PE ratio for the PE ratio for our quoted company. So let me actually write XYZ here. So PE ratio for XYZ is that. Now let me copy the formula to the right and see what will happen. So we have 12.5. So this 12.5 can be adjusted for the 20% here to get the adjusted PE ratio for ABC, which is the unquoted company, and then we will use that to calculate the NPS, and we can just therefore conclude that the price to be quoted for the 2,000 shares is going to cost between this amount and the amount we will get here. So that is what I'm basically talking about. That is what the question demands. So we have to suggest a price range, so between one price and the other. So that is how we do it for each of these items. So after using the 2022 figures, you come here and use the average, but this will not apply for our assets because we don't have an average value for the assets method. And then the second part of the question asked us to outline any 4 factors that the shareholders of ABC may consider in fixing the final price. Alright, so some of the factors that we may consider are 1, whether the business is a going concern. Now this is a going concern business because the business owns 5,000 shares. We are just trying to sell additional 2,000, or we want to issue additional 2,000 shares, and so we would consider whether the business is a going concern. We will also consider whether we are the buyer or the seller. And in this case, we are the seller, or ABC Limited is the seller. And so what we will do is that we will quote the price that is the highest. So we'll quote the price. So looking at these prices, we have the EPS or the PE ratio giving us 53.44 per share. The earnings yield giving us 55.68 per share, and also the NPS giving us 50.67, and this one is 46. So this is the lowest, so we won't go for this. So we'll assess it and look at the one that will give us the highest returns. The highest returns, that is what we'll go for. So first we look at the going concern position, whether the business is a going concern. We'll look at the buyer or seller perspective. We'll also look at the total shareholding that is to be bought. So we are looking at 2,000 shares. So this one is already determined. And then lastly, we can also see whether the company is quoted or unquoted. So this is an unquoted company. So whatever we are doing here, we will have to compare it to a quoted company. And some values such as PE ratio, the earnings yield cannot be obtained for an unquoted company. So what we do is that we consider that of the quoted company and adjust it for the relevant risk assumption and use the figures thereof. Alright, so that is it for this question. Thank you very much for your time. If you haven't subscribed to the channel, kindly do so and hit the notification button, because we'll be covering a lot of these in future videos. Alright, so thank you very much and have a lovely day.